Tourism in Las Vegas is in a big slump this summer, costing the city billions of dollars. Some are saying that could signal trouble ahead for the U.S. economy.
What happens in Vegas could spell trouble for the U.S. economy. The subject of chatter on social media, one even saying Vegas is actually dead. While maybe a bit extreme, the numbers do back up a summer tourism slump.
They're asking the right question. Are we heading toward an economic slowdown? And Vegas is just the first city to show it? Because this isn't just about empty sidewalks. It's about a city that historically reacts first when American households start tightening their wallets. Vegas runs on discretionary money. Nobody needs to go to Vegas. When people feel strong, they book the trip. When they feel squeezed, they cancel it. And right now, the numbers are not subtle. Visitor traffic down 11% in June, 7% down year to date. Canadian flights down 18%. Hotel occupancy softening, convention attendance dropping by the tens of thousands. That's not a vibe shift. That's demand evaporating. And here's the part that should make Wall Street uncomfortable. Vegas has a pattern. Before the housing crash, before the worst of the Great Recession, before local unemployment spiked, Vegas visitation cracked first. Not because Vegas causes recessions, but because it reflects consumer confidence faster than almost any other city in America. Vegas doesn't sell necessities. It sells excess. And excess is the first thing households cut. So the real question isn't whether Vegas feels slower. The real question is what happens next if this trend continues into the fall. Because if Americans are cutting Vegas now, what are they cutting next? Let's break it down properly. Las Vegas doesn't survive on stability. It survives on volume. More than 40 million visitors come through annually in strong years. Tourism and hospitality account for over a quarter of the city's workforce. When visitor numbers drop, it is not cosmetic. It hits payroll, tips, small businesses, real estate, and tax revenue. This summer, the slowdown is measurable. An 11% June drop mirrors something eerily familiar. During the Great Recession, January 2009 marked one of the worst declines in modern Vegas history, also around an 11% drop year over year. Back then, the ripple effects were brutal. The housing market collapsed, property values fell dramatically, construction halted, unemployment surged. Now, no one is saying we are in 2009 again. But in Vegas, double-digit visitor declines are not ignored. Because Vegas is not just a vacation destination, it is a discretionary spending thermometer. And when discretionary spending cools, it usually means consumers are feeling pressure. Las Vegas tends to get hit early in economic slowdowns for a simple reason. It is almost entirely discretionary. No one needs to go to Vegas. It is not a necessity. It is not groceries. It is not rent. It is not healthcare. It is extra. When inflation rises, when credit tightens, when households feel squeezed, the first things cut are travel, entertainment, and high-risk spending. And Vegas is built on all three. Even small changes in consumer confidence translate into noticeable drops in visitation. Economists often call Vegas a bellwether city because when the business cycle slows, it shows up in hotel bookings, convention traffic, and airline routes faster than in manufacturing or logistics data. In other words, Vegas often whispers before the broader economy speaks. The broader U.S. tourism market is expected to contract this year by an estimated $12.5 billion, according to industry projections. That's not just Vegas, that's nationwide softness, but Vegas feels it more intensely because of its concentration. Unlike diversified cities that rely on manufacturing, logistics, finance, or tech, Las Vegas leans heavily on discretionary travel. When tourism slows nationally, the Strip doesn't absorb the shock. It magnifies it. International visitors are critical to that equation. They stay longer, they spend more per trip, they book premium rooms, they attend shows, they dine at high-margin restaurants, and Canadian visitors in particular represent a meaningful share of Strip traffic. Right now, flights into Las Vegas from Canada are down more than 18% compared to last year. That is not a rounding error. Why? Part of it may be currency pressure. When the Canadian dollar weakens against the US dollar, Vegas becomes instantly more expensive. Part may be political tension. Cross-border travel sentiment can shift quickly. Part may be travel cost fatigue after years of rising airfare, hotel rates, and fees. And then there's the tariff conversation. New trade tensions and tariff announcements have introduced economic uncertainty. Analysts estimate that recent tariff impacts could cost the average American household roughly $2,400 per year in additional expenses. That cost doesn't show up all at once, but it compounds across goods, energy, and supply chains. That money comes from somewhere, and when household budgets tighten, luxury weekends in expensive cities become harder to justify. Travel becomes conditional. Maybe later replaces book it now. Vegas is not insulated from that psychology. It depends on it. Vegas has quietly become more expensive. Not dramatically overnight, incrementally. Resort fees continue climbing, often added after the base room rate is displayed. Parking fees, once rare on the Strip, expanded across major properties. Dining prices have surged. Premium cocktails easily run $20 to $28. Bottled water on the Strip can approach double digits. Even quick service options feel inflated compared to pre-2020 norms. A weekend in Las Vegas that once felt affordable now regularly exceeds $1,500 to $2,000 for mid-range visitors when hotel, food, shows, and moderate gaming are combined. For premium visitors, the number climbs much higher. In an inflationary environment, that matters. Consumers may still want to travel, but when perception shifts from value fun to expensive risk, behavior adjusts. Visitors shorten trips, they cut shows, they gamble less time, they stay off Strip, or they postpone entirely. Interestingly, one segment has not collapsed this summer: gambling revenue. Despite softer visitation, gaming floors are still generating strong handle numbers. Sports betting, table games, and slot revenue have not fallen proportionally with visitation declines. That suggests something subtle: fewer visitors, higher spend per visitor, or a concentration of spending among specific segments, particularly high-value or event-driven guests. In other words, volume may be falling, but intensity hasn't collapsed yet. But that dynamic has limits. Gaming revenue is heavily influenced by total foot traffic over time. If visitation continues falling, even strong per capita gaming spend cannot offset volume decline indefinitely. At some point, fewer bodies in the building translate into fewer dollars on the floor, and casinos understand that math very clearly. Over the past decade, Las Vegas has aggressively diversified. It brought in professional sports teams. The Raiders relocated from Oakland. The Golden Knights built NHL presence and quickly created a loyal fan base. The Strip was transformed into a Formula One circuit, turning roads into global broadcast stages. The high-tech sphere became a visual landmark and a high-demand concert destination. The goal was clear: reduce dependence on pure tourism and gambling, expand into entertainment, sports, large-scale events, and technology-driven experiences that attract global audiences. And, to some extent, it worked. Event-driven spikes now generate enormous short-term revenue bursts. F1. Weekends alone inject massive spending into hotels and restaurants. Arena events create premium room demand. The sphere commands global attention. But diversification does not eliminate vulnerability. It reduces it. Sports attendance still relies on discretionary spending. Concert tickets are expensive. F1 weekends attract high-end visitors and corporate clients, not broad middle-class volume. These events amplify peaks, but they don't necessarily stabilize valleys. Vegas diversified upward. That makes it more resilient to certain shocks, but potentially more sensitive to premium demand volatility. If high-end discretionary spending tightens, the new Vegas model feels that quickly. No, credit markets are not freezing. Banks are not collapsing. Construction cranes have not vanished from the skyline. The financial system does not appear to be under acute stress, but the parallel that matters is behavioral. In 2008, visitation dropped before housing collapsed locally. Demand softened before layoffs surged. Vegas showed the early signs. In 2020, visitation collapsed instantly due to shutdowns. That was different. External shock, immediate halt. In both cases, Vegas reflected national stress early. This summer, we are not seeing collapse. We are seeing softness. And softness is harder to interpret because it can either stabilize or accelerate. If visitation rebounds in autumn and convention season strengthens, this becomes a seasonal adjustment amplified by online exaggeration. If visitation continues trending downward into peak convention months, analysts will take it more seriously. because that would indicate not just summer fatigue, but sustained demand cooling. Vegas doesn't need a crisis to feel pain. It just needs margin compression. A few percentage points off occupancy, slightly lower ADR, softer food and beverage spend, lower gaming hold, stacked together, that becomes meaningful. More than a quarter of the Las Vegas workforce depends directly on hospitality and tourism. That concentration is powerful during booms. It is painful during slowdowns. When occupancy drops, shifts get cut. Overtime disappears. Tip income declines. Housekeeping schedules shrink. Restaurant staffing tightens. Event crews work fewer hours. That impacts local spending almost immediately. Local spending feeds housing demand, retail traffic, auto purchases, and service businesses. When tourism wages slow, the secondary effects ripple outward. Vegas experienced this brutally in the late 2000s when housing values were wiped out and unemployment soared. Entire neighborhoods were reshaped by foreclosure waves. Recovery took years. The city has rebuilt since then. Home values recovered, sports franchises increased profile, investment returned, infrastructure improved, but the structural vulnerability remains. It is still highly concentrated in one economic engine. And when that engine slows, the multiplier effect moves quickly. Vegas feels recessions early because it is designed for expansion. Experts are cautious. 1 month does not define a cycle. One soft quarter does not confirm a recession. Summer travel can fluctuate. Extreme heat can deter walkable tourism. Airline pricing shifts rapidly. Fuel costs, exchange rates, and geopolitical events all influence short-term tourism flows, but trends matter more than months. An 11% drop year over year is not noise. 7% down year to date is not random. 18% fewer Canadian flights is not coincidence. When multiple metrics move together, visitation, occupancy, international arrivals, analysts watch closely. Because Vegas doesn't decline in isolation. It reflects sentiment, and sentiment drives spending. If households feel confident, Vegas fills quickly. If households feel uncertain, Vegas empties quietly first. And that's why this summer's numbers matter more than social media videos. Because beneath the viral clips and dramatic headlines, the real question remains, is this a temporary cooling or the early stage of a broader shift in consumer confidence that hasn't fully surfaced in national data yet? The next few quarters will tell us, and Vegas will likely show it before most other cities do. Las Vegas has often been called the canary in the coal mine for the US economy. When times are good, Vegas booms. When confidence cracks, Vegas shows it quickly. Right now, we are not looking at collapse. We are looking at contraction. Whether that contraction deepens or stabilizes will tell us a great deal about where consumer confidence is heading nationally. If households absorb tariff costs, inflation pressure, and higher living expenses without cutting discretionary travel, Vegas rebounds. If households tighten further, Vegas will show it before GDP reports do. And that is why analysts, investors, and policymakers quietly monitor Strip visitation numbers more closely than they admit. Because when Vegas slows, it's rarely just about Vegas. It's about confidence. And confidence is the fuel of the American economy. The next few months will tell us whether this was just a summer lull or the first warning light flickering on. This is exactly why we watch Vegas. Not for the headlines, not for the hype, for the signals. Because long before the national narrative shifts, the Strip usually moves first. And if you understand what to look for, you don't just follow the cycle, you anticipate it. This is Casino Insider. If you want real analysis without the noise, stay with the series. The numbers are moving, and we're going to track every one of them.